Hello, everyone, and welcome to today's podcast. In this podcast, I would like to talk about inflation in Canada and other countries. And if you don't care about inflation, you definitely should, because in some countries, like Venezuela, inflation is running at 1,000,000%. So we always have to be prepared for extreme outcomes when it comes to inflation. What is inflation for those of us who don't know? Inflation is the steady increase in consumer prices. So if I go to a grocery store and I paid $100 last year for a basket of groceries, this year, depending on what the inflation rate is, I'm going to pay more. So in Canada, we had the latest number for July 2018, and the inflation rate is running at 3%. I think this is the highest rate in 12 months, or as far as I have been following it since 2008. So if you read the news here on the StatsCan website, the consumer price index rose 3% on a year-over-year basis in July, following a 2.5% increase in June. And then they talk about various components of the index in terms of how they calculate it. All right, well, 3% doesn't seem like a lot. It doesn't seem like a lot of money or purchasing power. However, what if you multiply that by 10 years? If you start ignoring this number every year, and let's say you have $10,000 in the bank, after 1 year, we lose 3% of our purchasing power. After 10 years, we lose 30%. So this is why we need to be careful when it comes to inflation. We need to make sure, or at least I want to make sure, that I keep my purchasing power. I don't want to lose it because I work hard for my money, and I'm sure you do as well. All right, so does it matter for you if you have a small bank account? Let's say I have $100 in my bank account. Does it matter? I think it matters as well, just as much, because it's about developing a habit. Once you start watching inflation numbers, once you start understanding financial markets, you're going to get more and more money, and you need to be able to protect those funds that you earned or that you worked so hard for. All right, so how do we protect against inflation? Because I don't want to lose 3% every year. I don't want to pay more for groceries. It's not like I have a choice, but I actually have to pay more for groceries, and I have to pay more for gas. If you look at this news release, consumer prices for gasoline increased 25% since last year. Well, okay, we don't spend all our money on gasoline, and the average is 3%, so we shouldn't worry too much about gasoline, but we worry about the basket of goods and services, and thus we need an instrument, a financial instrument, to protect ourselves against inflation. So just looking at what is available to us retail investors, I pulled up some examples. So one is just my brokerage account. Here I have a list of GICs, or guaranteed investment certificates, from a Canadian bank. So we have different issuers, about 12, 13 issuers here. And these instruments are pretty much risk-free. So if the issuer defaults on this instrument, then CDIC, which is Canada Deposit Insurance Corporation, will return the money to you. It's a federal corporation that protects your deposits, as long as you don't invest more than $100,000 in any single issuer. There are other rules for CDIC, and I encourage you to go to their website and check, but that's the high-level overview. Okay, so we have a GIC that is paying 2.31% for 1 year. It's not as high as inflation, but nevertheless, it protects my money, and I don't see why I shouldn't protect it. Why should I just leave it in the bank and lose 2%? As well, I can buy other GICs here from Canadian Western Bank, HSBC, and others. It's up to you what you want to choose. Also depends what your broker offers. And these are, by the way, if you open an online brokerage account with a Canadian bank, or if you go and speak to a financial advisor or an investment advisor at your financial institution. The choice is completely up to you, but hopefully they find something for you that pays just as much or a little bit more than that. All right, so another good deal is that I found is from Tangerine. If you open a new account with Tangerine and you invest with them in the savings account, they will pay you 2.75% for 6 months. All right, there are no fees for this account. All you have to do is transfer money into this account and get the interest, right? Once again, yes, you are getting the interest, but the interest is less than the rate of inflation. So how do we reconcile that, or how do we make sure that we get our money back? And in this case, we actually can. This is the highest rate that I found in the market, 2.75% as of yesterday. Now the inflation number just came out, so if you don't really know what's going to happen to these rates, I think they're going to go higher and higher. So 2.75% is not fixed here. ING will pay you more if the interest rates increase, or it depends what the offer is, because they usually have the right to resign the offer at any time. But it protects most of my money, and I'm happy just with that. So these are no risk investments. These are pretty much zero risk investments. If you have your money, if you want to use your money in the short term and you have some purchases coming up, or you want to spend money on a birthday or vacation, these are probably the right instruments because they involve no risks. There are no price fluctuations in these instruments, and you pretty much can get your money back at any time. Tangerine is probably a better offer because with Tangerine, you can withdraw the money at any time, whereas with most GICs, you have to keep them in that instrument for about a year or less, depending on what the term is, but it's not an instant withdrawal usually. You can just not get access to your money right away. All right, so these are the risk-free products. There are some risky products you can think about. For example, one of the products is a real return bond. What is a real return bond? A real return bond is a bond that increases in value once there's inflation. So let's say the price of a bond is 100. You buy a bond, regular bond, for $100. Inflation is running at 3%. The price of the bond increases to 103 next year, and you get an interest payment, which is generally right now is about 2.5%. So it's a pretty good deal. However, these instruments are not really well understood by most investors, and they are not very liquid, meaning if you want to sell them, they may not be buyers for those instruments because they're not very well promoted. They're only issued by the governments, such as the government of Canada, as well as the provincial governments. So the market is really liquid. Also, there are not too many of them in the market, the inflation protected bonds, or real return bonds. Most of them are long-term securities, meaning they fluctuate in price a lot more. So you really have to consult your investment advisor or your financial advisor to make sure that they're right for your situation. You can buy them directly from your dealer, or you can choose an ETF. So here I found two ETFs that I am personally going to be using. The first one is ZRR, BMO Real Return Bond Index ETF. And here you see performance chart in terms of how the price of this ETF has been moving. Sometimes it drops. So here it dropped from, I think, from 12,960, almost 13,000 to 11,000. So these instruments are a little bit tricky. They're a little bit more advanced. They're not risk-free, although they're issued by governments. So you really have to pay attention and know what the market is going to be like. So speak to your advisor, do more research if you have to, but this is just another option. All right. Think about other currencies as well. So the inflation in Canada is running at 3% right now, right? In the United States, it's about the same. But what if a certain government makes a mistake? Right? What if there's a political risk in the country? So what happened in Venezuela, for example, right? What happened in Venezuela is they devalued their currency, meaning the currency value dropped. And one of the reasons for that is because the inflation rate in Venezuela is projected to be 1,000,000% in 2018. So this is what I mentioned at the beginning of podcast. If you have money in the bank and you don't really care about inflation, well, this is what happened to some people in Venezuela. It's not widespread, definitely not widespread. Not everyone is impacted. It's a smaller country which is basically deriving a value from its oil deposits. They don't really have a diversified industry like Canada or United States. They don't really have a service industry. But here's what's happening with the currency, right? We have Canadian currency, we have US currency, and we have a currency in Venezuela. If you're holding that currency, you would lose 99% of its value. So if you had $10,000 or whatever the currency is in Venezuela, you would lose 99999 of it. So 99.99% of it would be wiped out because the prices increased so much. Right? So just in terms of thinking about Canadian dollar is unlikely to suffer the experience of Venezuela, right? However, we did have a 12 or 13% inflation rate in the 80s. United States was in a similar situation, and so was the rest of the world. So, however, we can diversify between countries, right? So instead of leaving all our money in one currency, maybe we can buy some US dollars, maybe we can buy some euro, maybe we can buy some other currencies, maybe we can have investments in other countries or buy bonds in other countries. But we can always consider about diversifying our currency portfolio. See if you can get a better rate, right? That's another thing that you can do. I think this is it for today's podcast. I encourage you to look at economic news in the near future. I personally expect the rates and inflation to be going up, especially in Ontario, because in Ontario we increased the minimum wage. What that means is people are getting more money and they're spending that money. And in Ontario, we still have a very active housing market. So the prices of houses are going up. People are selling it. They're taking the gains out of the housing market and they're spending that money. Meaning what usually happens is the prices of other goods and services are also going up. If you have a salary negotiation with your employer, make sure you mention this article, because some employers just don't know about purchasing power, right? They don't know the news, they don't know what's happening. But if they understand that you just lost 3% of your purchasing power, they may be a little bit more open if they want to keep you with the company. That's it for today's podcast, and I hope you enjoy your weekend. Thank you.